Every generation reaches the same conclusion about money. Not that it has improved, not that it's become slightly safer, but that it has finally been understood. They say it with confidence, with charts, with new language, with fresh theories that promise to tame risk, smooth cycles, and turn uncertainty into something measurable, something scientific, something civilized. And every time, history waits, because behind the new tools, the smarter models, and the faster markets, there is one constant that never changes: human behavior. And human behavior is remarkably loyal to its illusions. This time is different. Those 4 words have preceded more financial disasters than bad math ever did. They were spoken by merchants in 17th century Amsterdam, by bankers in 1920s New York, by traders in late 1990s Silicon Valley, by policymakers armed with degrees, forecasts, and far too much certainty. Each time, the belief was sincere. Each time, the outcome was familiar. Welcome to the Financial Historian, where money, power, and history collide. And nothing is ever as simple as it looks. This isn't a story about one crash, one bubble, or one mistake. It's about something deeper, something quieter. Why the same economic illusions keep resurfacing, century after century, even as societies grow richer, smarter, and more technologically advanced. If markets were purely rational, economic history would be boring, linear, predictable. But markets aren't machines. They're mirrors. They reflect fear, optimism, greed, denial, and hope, often all at once. And when enough people believe the same comforting story, illusion hardens into consensus. Step back and look at the pattern. In the 1630s, Dutch traders convinced themselves tulip bulbs had transcended agriculture and become a new asset class. Prices detached from usefulness. Logic followed price. Anyone who questioned it simply didn't understand the market. 3 centuries later, investors said the same thing about radio stocks in the 1920s, conglomerates in the 1960s, dot-coms in the 1990s, housing in the early 2000s. Different centuries, different assets, identical logic. What changed wasn't the illusion. It was the costume. Each era wraps optimism in the most advanced language available. Trade routes, industrial productivity, financial engineering, algorithms, liquidity, new paradigms. Sophistication grows, vulnerability remains, because illusions don't survive by being obviously false. They survive by being emotionally useful. One of the oldest illusions humans fall for is the belief in permanent growth. That progress, once achieved, becomes a law of nature. That tomorrow will always be bigger than today, not because of discipline or restraint, but because the system itself guarantees it. Empires believed this. Corporations believed it. Governments believed it. Households still do. Growth stops being a result and becomes a promise. And once growth is assumed, anything that threatens it feels temporary. A glitch, a correction, something that can be fixed with the right level. So when growth falters, societies rarely question the belief. They question the obstacle. Credit expands. Rules loosen. Risk is pushed forward in time. Pain is deferred, not eliminated. The illusion survives a little longer. As systems grow more complex, another belief quietly takes hold. That complexity equals safety. That slicing risk, modeling it, insuring it, and dispersing it somehow makes it disappear. It doesn't. Complexity doesn't remove risk. It redistributes it. It hides it. It delays its visibility. When no one fully understands the system anymore, fear fades. And when fear fades, caution disappears with it. If complexity prevented disaster, the most sophisticated financial systems in history wouldn't keep failing so publicly. But complexity serves a different function. It creates distance between cause and consequence. It dissolves responsibility into process. It makes failure feel technical instead of human. And most importantly, it creates the illusion that someone, somewhere, is in control. That belief is one of the most powerful economic sedatives ever invented. Central banks, regulators, institutions, experts, societies place enormous psychological weight on the idea that there is a cockpit and someone competent is sitting in it. Not because it is always true, but because believing it keeps the system moving. Confidence, after all, is a form of currency. Yet history shows control is often reactive, fragmented, and constrained by incentives that rarely align with long-term stability. Decisions are made under pressure, with incomplete information, and with political consequences hovering over every move. The appearance of control buys time. It doesn't guarantee outcomes. Meanwhile, costs don't disappear. They shift. Debt pulls future growth into the present. Inflation quietly reduces obligations. Bailouts spread losses across systems instead of individuals, or at least that's how it is sold. Each mechanism feeds another illusion. That pain can be managed without being paid. That consequences can be postponed indefinitely. That someone else will absorb the impact. History is ruthless on one point. Costs always surface, and when they do, they rarely land evenly. Some exit early. Some gain quietly. Some never recover. Entire generations can do everything right and still inherit systems burdened by decisions they never consented to. That isn't a moral failure. It's a structural one, born from illusions that outlived their usefulness. The most dangerous moment in any economic cycle isn't collapse. It's confidence. The moment people believe the system has evolved beyond its own history, that risk has been mastered, that warnings are outdated, that skeptics simply don't get it. History doesn't repeat because it wants to. It repeats because human psychology hasn't evolved at the same speed as financial systems. And in that gap between innovation and behavior, illusions thrive. What makes these illusions resilient isn't ignorance. It's familiarity. By the time a system shows stress, most people living inside it have never known anything else. The rules feel natural. The incentives feel permanent. The structure feels inevitable. Questioning it sounds less like wisdom and more like heresy. After every collapse, societies promise restraint. They build safeguards. They write regulations thick enough to reassure themselves it won't happen again. But memory fades faster than systems decay. Safeguards become obstacles. Rules become inefficient. Caution begins to feel excessive. New participants enter. They inherit the rewards, not the scars. To them, warnings sound like myths from a less advanced age. That's how illusion regains ground. Economic cycles don't require stupidity. They require amnesia. The modern world hasn't escaped this pattern. It's accelerated it. Information moves faster. Markets react in milliseconds. Capital crosses borders instantly, but decisions are still filtered through the same emotional machinery that once guided merchants loading ships by candlelight. The tools are sharper. The instincts are unchanged. Short-term success is still mistaken for proof. Rising prices are still confused with value. Complexity is still treated as intelligence. And when something works long enough, people stop asking why it works and start assuming it always will. That's the quiet danger of sophistication. It anesthetizes skepticism. Economic systems don't collapse because everyone misunderstands them. They collapse because enough people understand them, just enough to exploit incentives, while assuming someone else is managing the downside. No system can outgrow the psychology of the people operating it. Markets don't fail because charts were wrong. They fail because humans overestimate control, underestimate risk, and delay accountability when the cost isn't immediate. And when consequences arrive, they're framed as anomalies, external shocks, unforeseeable events, anything but patterns that were visible all along. History isn't useful as a crystal ball. It's useful as a mirror. It shows how easily societies trade long-term resilience for short-term comfort. How systems built to manage risk slowly become systems designed to postpone it, and how those postponements always come with a price. Financial resilience doesn't come from timing markets. It comes from recognizing where illusions live and refusing to build your life entirely inside them, from understanding that incentives shape behavior, that complexity often hides fragility, that no era is immune. History doesn't punish ignorance immediately. It waits. It lets confidence rebuild. It allows new stories to form, and only then does it collect its due. The people who suffer most aren't those who never believed the illusion. They're the ones who believed it had finally disappeared. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.